Introducing a beginner's manual on technical analysis, a comprehensive video series tailored specifically for those who are new to the world of trading. Whether you're just starting out or looking to deepen your understanding, this series is your roadmap to success. Throughout this series, we'll cover everything you need to know to get started with technical analysis. From understanding chart patterns to deciphering key indicators, each episode will equip you with the knowledge and skills necessary to make informed trading decisions. So, if you're ready to take the first step towards becoming a confident and successful trader, be sure to subscribe to our channel and hit that notification bell so you never miss an episode. Together, let's unlock the secrets of technical analysis and pave the way for your trading journey. Let's dive in. Hey there, fellow traders. Welcome back to Risk with Purpose, your ultimate destination for learning to trade with confidence and precision. I'm Technical Tiffany, and today we're diving deep into the fascinating world of price charts, their types, time frames, and interpretation. Whether you're a seasoned trader or just getting started, understanding price charts is essential for making informed decisions in the market. So, grab your notebooks, because we're about to break it all down for you. Welcome to the first lesson in Section 2, Basic Concepts of Technical Analysis. In this lesson, we're diving into the foundational elements of price charts, a cornerstone of technical analysis. We'll unpack the diverse types of charts, delve into different time frames, and equip you with the skills to interpret them adeptly. Mastering price charts is pivotal for deciphering market trends and uncovering potential trading prospects. So, buckle up as we embark on this journey to enhance your understanding of technical analysis and empower you to navigate the markets with confidence. Charts aren't just a jumble of lines and squiggles. They're a visual representation of market sentiment, supply and demand dynamics, and the battle between buyers and sellers. By analyzing charts, you can decipher patterns, identify trends, and make better decisions about when to buy, sell, or hold. Charts are like a time machine, allowing you to peer into the past and glean insights into future price movements. Just as historians study ancient texts to understand the rise and fall of civilizations, traders pore over charts to uncover the secrets of the market's ebbs and flows. Whether you're looking at candlestick patterns, moving averages, or support and resistance levels, charts provide a wealth of information that can help you anticipate where prices might be headed next. But charts aren't just a tool for predicting the future, they're also a way to stay grounded in the present. Like a sailor navigating by the stars, traders use charts to stay on course and avoid getting lost in the sea of noise and speculation. In a world where news travels at the speed of light and markets can swing on a dime, charts provide a steady anchor, helping traders stay focused on what really matters, price action. So, the next time you feel lost in the world of trading, just remember charts are your compass, your roadmap, your guiding light. With their help, you can navigate the turbulent waters of the market with confidence and clarity, knowing that you have the tools you need to chart your course to success, no pun intended. Types of price charts. Line charts. A line chart is a basic type of chart that represents the price movement of a financial instrument over a specific period. It is one of the most straightforward and commonly used chart types due to its simplicity and ease of interpretation. A line chart displays the closing prices of the asset at regular intervals, such as daily, weekly, or monthly, by connecting them with a continuous line. A line chart typically plots the closing prices of the financial instrument on the vertical and the time intervals on the horizontal axis. Each data point represents the closing price of the asset at the end of a specific time period, such as a trading day, week, or month. The closing prices are connected with a line, creating a visual representation of the price movement over time. The line extends from one closing price to the next, forming a continuous line that shows the direction and magnitude of price changes. Line charts are known for their simplicity and clarity. They provide a quick overview of price trends and patterns without overwhelming the viewer with excessive detail or noise. Due to their simplicity, line charts are particularly useful for beginners or those looking for a high-level view of price movements over time. They can help traders identify major trends and key support/resistance levels with minimal effort. Line charts focus solely on closing prices, ignoring the intraday fluctuations that occur throughout the trading session. This emphasis on closing prices is based on the belief that closing prices are more significant as they represent the consensus of market participants at the end of the trading period. By focusing on closing prices, line charts provide a smoother representation of price trends and reduce the impact of intraday noise, making it easier for traders to identify meaningful patterns and trends. Line charts are simple and therefore effective for identifying trends in the market. An upward sloping line indicates an uptrend, where prices are generally rising over time. Conversely, a downward sloping line indicates a downtrend, where prices are generally falling. Horizontal lines indicate periods of consolidation or sideways movement, where prices are trading within a range with no clear trend. While line charts offer simplicity and clarity, they have limitations compared to more advanced chart types such as candlestick charts or bar charts. Line charts do not provide information about the intraday price range, opening prices, or highs/lows during the trading session. As a result, line charts may not capture all the nuances of price movements, especially for traders who require more detailed information for their analysis. Bar charts. Bar charts visually represent the price movements of an asset within a chosen time frame using vertical bars. Each bar on the chart corresponds to a particular time period, such as a day, week, month, or any other chosen interval. Each bar on a bar chart encapsulates 4 essential price points: the highest price, high, lowest price, low, and the closing price, close, for the given time period. The top of the vertical bar represents the highest price reached during the time period, the bottom represents the lowest price, and the right horizontal line represents the closing price. The vertical line is often referred to as the wick or shadow, while the horizontal lines are sometimes called ticks or bars. Bar charts can be color-coded to visually distinguish between bullish and bearish price movements. Bullish bars, where the closing price is higher than the opening price, may be shaded or colored differently from bearish bars, where the closing price is lower than the opening price. Some charting platforms use green or white bars to represent bullish price movements and red or black bars to represent bearish price movements. This color coding helps traders quickly identify market sentiment and trends. Candlestick charts. Candlestick charts provide insights into market sentiment, price action, and potential trend reversals. Originating in Japan in the 18th century, they've since become a popular tool among traders worldwide. Candlestick charts represent price movements using individual candlesticks for each time period, such as a day, week, or month. Each candlestick has a body and wicks or shadows that extend from it. The body of a candlestick represents the price range between the opening and closing prices for the given time period. If the closing price is higher than the opening price, the body is typically colored white or green to indicate a bullish or positive price movement. Conversely, if the closing price is lower than the opening price, the body is shaded red or black to represent a bearish or negative price movement. The wicks or shadows extending from the body represent the highest and lowest prices reached during the time period. The upper wick extends from the top of the body to the highest price, while the lower wick extends from the bottom of the body to the lowest price. Candlesticks vary in size, with larger bodies indicating greater price volatility and smaller bodies suggesting lower volatility. Timeframes. Short-term timeframes. Intraday short-term timeframes, also known as intraday timeframes, refer to chart intervals that focus on capturing price movements within a single trading session. These timeframes, such as 1-minute, 5-minute, or 15-minute charts, provide traders with detailed snapshots of market activity and are commonly utilized by day traders and scalpers. Short-term timeframes zoom in on price movements occurring within a single trading session, typically spanning from the market open to close. These timeframes offer a rough view of intraday price action and allow traders to analyze market dynamics on a minute-to-minute or bar-by-bar basis. Day traders focus on capturing short-term price movements within the same trading day. They rely on short-term timeframes to identify intraday trends, momentum shifts, and trading opportunities. Day traders aim to profit from fluctuations in asset prices by entering and exiting positions multiple times throughout the day. Scalpers are traders who specialize in making small, quick trades to capitalize on micro price movements. They use short-term time frames, such as 1-minute or 5-minute charts, to execute rapid-fire trades and exploit short-lived price fluctuations. Scalpers aim to profit from small price increments by entering and exiting positions within seconds or minutes. Short-term timeframes offer a close-up view of market dynamics, revealing intraday price fluctuations, volatility spikes, and order flow patterns. Traders can observe how prices react to news releases, economic data, and other market events in real time, enabling them to make quick decisions based on current market conditions. Short-term or intraday price movements can be influenced by a variety of factors, including intraday news, earnings announcements, technical levels, and algorithmic trading strategies. Traders use short-term charts to monitor these factors and adjust their trading strategies accordingly. Short-term timeframes are valuable for identifying precise entry and exit points for trades. Traders use technical analysis tools such as moving averages, support and resistance levels, and momentum indicators to pinpoint potential entry and exit signals on short-term charts. By analyzing short-term price movements and patterns, traders can efficiently execute trades with optimal timing, maximizing their potential gains and minimizing their exposure to market risks. Short-term timeframes provide traders with real-time insights into market activity, allowing them to react quickly to changing market conditions. Traders can monitor price movements, volume spikes, and order flow dynamics in real time, enabling them to adjust their trading strategies on the fly. Real-time access to market data and short-term charts empowers traders to stay nimble and agile in fast-moving markets, facilitating rapid decision-making and execution. Medium-term timeframes. Weekly medium-term timeframes, including daily and weekly charts, play a crucial role in providing an extended view of price movements over several days or weeks. These timeframes are favored by swing traders and investors seeking to identify medium-term trends and trading opportunities. Medium-term timeframes, such as daily and weekly charts, offer an intermediate view of price action compared to short-term intraday charts and long-term monthly or yearly charts. Daily charts capture price movements on a day-to-day basis, while weekly charts provide a broader overview of price action throughout the week. Swing traders aim to capitalize on medium-term price movements by identifying trends and reversals that occur over several days to weeks. They utilize medium-term timeframes to identify potential entry and exit points for trades, based on technical analysis indicators and chart patterns. Investors use medium-term timeframes to gauge the overall direction of asset prices for medium-term investments. They analyze daily and weekly charts to assess the health of the market, identify major trends, and make informed decisions about portfolio allocation and asset selection. Medium-term timeframes offer a comprehensive perspective on market dynamics, capturing significant price movements and trends over several days or weeks. Traders and investors can observe the evolution of trends, support and resistance levels, and key price levels on daily and weekly charts. These timeframes help traders identify market turning points, trend continuations, and potential reversal patterns that may not be as apparent on shorter-term charts. Medium-term timeframes are instrumental in identifying evolving trends in the market. Traders and investors use daily and weekly charts to assess the strength and direction of trends, determine trend reversals, and establish trend-following strategies. Moving averages, trend lines, and momentum indicators are commonly used tools to identify and confirm trends on medium-term timeframes. Traders look for patterns of higher highs and higher lows in uptrends and lower highs and lower lows in downtrends to confirm the direction of the trend. Swing traders and investors rely on medium-term timeframes to make timely decisions about their trades and investments. Medium-term timeframes provide them with a balanced view of market dynamics, offering sufficient detail to identify trends and patterns without overwhelming complexity. Traders can make better decisions based on the comprehensive perspective provided by daily and weekly charts. Long-term timeframes. Yearly long-term timeframes, such as monthly or yearly charts, provide investors with a bird's-eye view of price trends over extended periods. These charts are followed less by traders, but more by long-term investors and trend followers who aim to identify major trend reversals and lasting investment opportunities. When viewing the markets through the lens of the big picture, it helps to assess charts of a longer time frame. These charts generally include the monthly and yearly charts. Monthly charts track price changes over the course of each month. Each data point on the chart represents the closing price for that particular month. These charts offer a broader perspective compared to shorter time frames like daily or weekly charts. They help investors filter out short-term noise and focus on longer-term trends. By analyzing monthly charts, investors can identify significant price movements and trends that may not be apparent on shorter-term charts. This allows them to make more informed decisions based on the underlying long-term trajectory of an asset. Monthly charts are particularly useful for identifying major trend reversals or trend continuations. Investors can spot patterns such as breakouts, consolidations, or trend shifts that may indicate significant changes in market sentiment or fundamentals. Investors who follow a buy and hold strategy or prefer long-term investments often rely on monthly charts to gauge the overall health and direction of the market or specific assets. Yearly charts provide a big-picture view of price movements throughout the year. Each data point represents the closing price at the end of the respective year. These charts offer an even broader perspective than monthly charts, allowing investors to analyze price trends over longer periods. Yearly charts are valuable for identifying multi-year trends, major support and resistance levels, and significant turning points in the market. Investors use yearly charts to assess the long-term performance of investments and to make strategic decisions about portfolio allocation and rebalancing. By observing yearly price movements, investors can gain insights into the underlying economic and market conditions that drive long-term trends. This helps them make more accurate predictions about future price movements and adjust their investment strategies accordingly. Interpretation of price charts. Identifying trends. Identifying trends in price movements is a fundamental aspect of technical analysis. Price charts serve as the primary tool for trend analysis, allowing traders to discern patterns and tendencies over time. In an uptrend, prices consistently make higher highs and higher lows as they ascend over time. Each successive peak reaches a higher level than the previous one, while each trough also rises above the preceding low. This pattern reflects a bullish market sentiment, where buyers outnumber sellers, propelling prices upward. Uptrends often occur during periods of economic growth or positive market sentiment, as investors express confidence in the underlying asset's value. Example: in an uptrend, prices consistently make higher highs and higher lows as they ascend over time. Each successive peak reaches a higher level than the previous one, while each trough also rises above the preceding low. Conversely, a downtrend manifests when prices form lower highs and lower lows, descending gradually over time. Each successive peak falls below the previous one, while each trough also declines further than the preceding low. This pattern indicates a bearish market sentiment, characterized by a surplus of sellers driving prices downward. Downtrends frequently occur during economic downturns or periods of pessimism in the market, as investors lose confidence in the asset's prospects. Example: a downtrend manifests when prices form lower highs and lower lows, descending gradually over time. Each successive peak falls below the previous one, while each trough also declines further than the preceding low. In contrast to uptrends and downtrends, a sideways or range-bound market exhibits horizontal price movements within a defined price range. Prices fluctuate within a relatively narrow band, with neither a clear upward nor downward trend dominating. In such market conditions, buyers and sellers are evenly matched, resulting in a balanced equilibrium between supply and demand. Range-bound markets often occur during periods of indecision or consolidation, when market participants await significant catalysts or events to drive prices decisively in one direction. Example: a sideways or range-bound market exhibits horizontal price movements within a defined price range. Prices fluctuate within a relatively narrow band, with neither a clear upward nor downward trend dominating. By recognizing these distinct patterns in price movements, traders can effectively identify trends and tailor their trading strategies accordingly. Whether capitalizing on bullish uptrends, profiting from bearish downtrends, or employing range-bound strategies, understanding market trends are a very important element of trading and investing. Support and resistance levels. Support and resistance levels are fundamental concepts in technical analysis, providing traders with essential insights into market behavior and potential trading opportunities. These levels, depicted as lines or zones displayed either above or below the price action, represent key price levels where significant reactions have historically occurred. Support levels signify areas where buying pressure has historically been sufficient to counteract selling pressure, halting or reversing a downtrend. Traders perceive these levels as significant because they represent price floors beneath which prices have struggled to decline further in the past. When prices near a support level, traders anticipate that buying interest will resurface, leading to a potential reversal or bounce in prices. Support levels can emerge from various sources, such as previous price patterns, psychological levels, e.g., round numbers, or technical indicators, e.g., moving averages. Traders use these levels strategically to identify opportune entry points for long positions, as they expect prices to bounce off support levels and begin an upward movement. Example: support levels signify areas where buying pressure has historically been sufficient to counteract selling pressure, halting or reversing a downtrend. Traders perceive these levels as significant because they represent price floors beneath which prices have struggled to decline further in the past. On the other hand, resistance levels signify price levels where selling pressure has historically outweighed buying pressure, hindering further upward movement in prices. These levels are perceived by traders as significant barriers above which prices encounter difficulty in rising. When prices approach a resistance level, traders anticipate heightened selling activity, often resulting in price reversals or pullbacks. Resistance levels can originate from various sources, such as previous price peaks, trend lines, or Fibonacci retracement levels. Traders employ these levels strategically to identify potential exit points for long positions or opportunities to initiate short positions. They anticipate that prices will encounter resistance at these levels, leading to potential corrections or reversals in price direction. Understanding resistance levels enables traders to anticipate challenges to price advancement and make informed decisions to manage their positions effectively. Example: resistance levels signify price levels where selling pressure has historically outweighed buying pressure, hindering further upward movement in prices. These levels are perceived by traders as significant barriers above which prices encounter difficulty in rising. Support and resistance levels are dynamic and can change over time as market conditions evolve. When a support or resistance level is breached, it may switch roles, with former support becoming resistance and vice versa. Traders employ various techniques, such as trendline analysis and volume analysis, to validate support and resistance levels and anticipate potential price movements. By recognizing and interpreting support and resistance levels, traders gain valuable insights into market sentiment and behavior. These levels serve as crucial tools for identifying entry and exit points, managing risk, and maximizing profit potential in the dynamic environment of the financial markets. Patterns and indicators. Price charts offer a wealth of information beyond just depicting price movements. They also unveil various patterns and technical indicators that provide deeper insights into market dynamics. These patterns and indicators are invaluable tools for traders seeking to decipher market trends and make informed decisions. Chart patterns, such as head and shoulders, triangles, flags, etc., are visual representations of price movements that repeat over time. Recognizing these patterns can help traders anticipate potential trend reversals or continuations. For instance, a head and shoulders pattern typically signals a reversal from an uptrend to a downtrend, while a triangle pattern suggests a period of consolidation before a potential breakout. Flags, on the other hand, often indicate a temporary pause in a prevailing trend before resuming in the same direction. Technical indicators complement chart patterns by providing quantitative insights into market trends and momentum. Moving averages, for example, smooth out price data over a specified period, allowing traders to identify trends more easily. Oscillators, such as the Relative Strength Index, RSI, and stochastic oscillator, measure the speed and magnitude of price movements, indicating whether an asset is overbought or oversold. Volume indicators, such as the on-balance volume, OBV, or volume bars, reflect the level of trading activity in the market, providing clues about the strength of price movements. By analyzing these patterns and indicators, you can gain a deeper understanding of market dynamics. Chart patterns help traders identify potential turning points in price movements, while technical indicators offer quantitative measures of market trends and momentum. Together, they form a comprehensive toolkit for traders to navigate the complexities of financial markets and capitalize on trading opportunities with greater precision and confidence. And that's it. Thank you for watching our video on price charts, their types, time frames, and interpretations. Remember, in the world of investing, knowledge is your greatest asset. Keep exploring, keep learning, and always trade objectively. If you enjoyed this video, don't forget to like, share, and subscribe to Risk with Purpose for more insightful content on navigating the markets with confidence and precision. And don't forget to visit www.riskwithpurpose.com for the trading resources you need to take your trading game to the next level. Until next time, stay informed and trade wisely.